Hello and welcome, everybody. Happy Monday. Welcome to another week. Hopefully you guys have a good weekend. Hopefully everybody's prepared for the snow this week, which I think is bogus. It's not even Thanksgiving. We shouldn't be getting snow yet. But here we are. So just wanted to pop on for a couple of minutes and talk about how sort of the week is shaping up already. I think there's a couple of economic indicators coming out this week that will be important to pay attention to really understand where things are going to go from here. I would say, the first real thing of note is, if we take a look at the stock market, and I would just kind of like to start there and understand what things are doing in the market. And we finished last week strong. The SPY and Dow Jones and the NASDAQ were all trending up, which is good, right? I mean, things are looking positive, and that's mainly driven from the softer than expected CPI data that came out. That was just a little bit less than people were forecasting, so that really started ramping things up. But if we put this into some context, you can see this broader sort of downtrend that's really it's been peaking off of. And so we expect that if it continues to rise up over the next couple of days or week, that sort of this 4,100 mark might be that peak where it starts to until we start to see another really sort of bear rally, I guess you would call it. Taking a look at, so where are mortgage rates heading? How's the housing industry really shaping up here? Just taking a look at the 10-year Treasury is, we pay a really close attention to that. For those that don't know, the 10-year Treasury note isn't the thing that necessarily sets the mortgage rates, but it's a good indicator of, they're correlated with the 10-year Treasury. And so we can pay attention on what that's doing and where mortgage rates are more likely heading. And, You saw really since last week when the CPI numbers came out, it took a big dive. Excuse me, and we saw mortgage rates come down a little bit last week, and we expect this will probably continue to tick up. Right, if we take a look at the longer trend here, it's 6 months. It's even a year. And this is the Fed. Jerome Powell said they're going to continue to raise rates, so we'll expect this continues to go up. It may, we may hover here through the end of the year. Just depends on sort of some of the other economic things that come out. Where was I? Here we go. Here are the things that are going to come out this week, and this is really cool to pay attention to, kind of week over week. There's always these new statistics that are scheduled to come out, and then as they publish, you can sort of see how the market reacts a little bit, right? So today, the 1 year inflation expectations came out at 5.9%, which is higher than previously expected, 5.4, and 5-year inflation the same. So no real, it's not really a shock to anybody. So if we go back to the S&P, and let's just bump this down to 15 minutes. I mean, you can see a little bit. We're up for the day a little bit, but down a little bit from last week. I think what's more is you see Fed Chair Lael Brainard is going to be speaking really realistically right now, or I guess would have already spoken. And so sometimes when they speak, that'll jar the markets a little bit, but it doesn't look like it's really had that much of an impact on the market today. I think what's more interesting this week is this real household debt, to really understand what this household debt number is going to be. And so this, this will really start to paint the economic picture of where the average American household is in terms of, savings rates and, how much money's in the bank. And that will really start to, as you're looking at a larger banking cycle, as things are moving through the credit cycle, and if you're moving into a recession, you expect things like repos, like car repossessions, debt restructuring, defaults, all those things to start to sort of tick up, right? And we're maybe a little bit too soon in the recession. A lot of that stuff, we'll say in the recession, too soon in the economic picture to start to see those things really tick up. But you can definitely start to see them as a leading indicator. Just imagine it like a tidal wave slowly making its way, right? And those things are really sort of the leading edge, or the at least going up the wave on the tidal wave. So when you're thinking like, where are we at in terms of economic, where the health of the economy, you can really start to pay attention to those default rates and things like household debt to really tell you like where we're at in the cycle of things. On the other side of consumer debt is consumer savings, right? So let's look at the consumer savings rate. And so this would have been the exact inverse. If we pull up the St. Louis Fed to take a look at some of this data, you can see, how much money do people have in the bank, and this paints a really good picture of why we started to see the inflation that we saw. And it's because if this thing ever loads, we may not get to see it. We're getting closer. Okay, here we are. So let's really focus this down to like the last 10 years. And you see, no surprise, in 2020 when they started, the stimulus funds started coming out, the U.S. The personal savings rate went way up in 2020, and then you see some of that in 2021 as well, and that's because you see these asset classes like the stock market and tech stocks really start to tick up in 2021, right? So as you see this start to tick up, you can kind of see some of that secondary, again, and stimulus as well, right? There's a round of stimulus payments, I think, in December and then in March of 2021. So you see kind of those bumps come in. But then ever since, it's been this decline of savings rate, which is expected, right? Like inflation's super high at this point. Things are expensive. We don't have additional stimulus money coming into the economy, so it's back to just like regular personal wages. And so then the inverse of that is, as this starts to tick down, you expect your household debt to tick up, right? If the personal savings rate's high, maybe not all the debt is gone, but it's certainly not maybe increasing at a rate that it may at this point, as now savings are gone. People's internal household liquidity or cash on hand is dwindling, and now people are turning to credit cards and lines of credit to pay the things for, and we're going into the holidays, right? So you expect some of this to tick up anyways. So we'll keep an eye on this real household debt and see, does it come in line? Does it come higher than expected? And then sort of like the retail sales, industrial production, those sort of things are going to be interesting to watch this week. Jobless claims coming in. So again, these will be the things that are like really interesting to watch this week and to understand what's going to happen. Building permits, housing starts, obviously for our industry, super important. And let's go back to some of these graphs that we have here. So what we're looking at here is existing home sales in the United States. Now, this isn't just Cedar Rapids and local markets. So, some of these numbers, I don't want to say are convoluted, but they have more data than just Cedar Rapids data. And so if you look at just this year, or the last 12 months really, you can see existing home sales are sliding quite a bit. This looks maybe more dramatic than it is just because of the scale of the chart, but you can see it goes from about 6,000 down to about 4,700. So definitely a decline. And if we go to a 25 years just to really start to take a look at 2008 and where were things there, you see this interesting sort of decline ahead of 2008, right? Which you think would have been more in line with 2008, but the decline started about 2 years before 2008. And so we're starting to see some of that decline now. So the question is like, do we see some of the same what happened afterwards of the 2008 financial crash or housing market crash? Maybe, right? We'll have to continue paying attention. I would say the 2020 drop here is sort of an anomaly based on COVID and some of the things that we are seeing at that time. But now, realistically, and this is a little more surprising than I expected, our market hasn't seen this downturn since the beginning of the year. It's really, we peaked in like June here in Cedar Rapids, and then it started coming down. So it looks like the broader market, though, of the U.S. has been coming down for the majority of the year other than January. So as we go back to, building permits and housing starts, that really gives you a good flavor of, what's the new housing market, how much appetite is there for builders to continue building, and sort of the absorption rate of those new homes. And all of that plays into, if we go back here. So this is new home sales, right? So again, sort of that, if we go back to the housing starts, how are those homes selling? And you can see the number of those homes selling is steadily increasing, but now we're starting to see big jump, and now things are starting to fall off a little bit. So all of that goes to the supply or the demand side of the equation, right? How much are people buying? And 9.2 months of supply. So this is, the demand side. If the demand side is slowing down, but housing starts are ramping up, then we're going to get out of balance a little bit, where supply is starting to outpace demand, which would start to drive home prices down. And as we see things slow down, that months of supply, like this is a pretty big jump in months of supply, right? 9 months is pretty slow absorption rate, meaning that if a new home goes on the market today, on average, it may sit there for 9 months until it's sold. And so that's pretty slow. But what we don't see is population growth slowing down, obviously, right? And so what you then get is sort of this disparity between this big gap of home sales going down and home sales going down, but growth continuing to rise. And that's sort of the same thing that led to the housing crunch that we're in now, which is for a time, demand was far outpacing supply. And that's because those big gaps in low interest rates. Now, the supply necessarily hasn't changed. And this is the thing that I think is different. The supply problem hasn't changed. The inventory realistically is still low and getting outpaced by population growth, but demand is getting squashed considerably, which was the Fed's intention with high interest rates, right? It's not unreasonable to understand that from 3% interest rates, a lot more people were buying than 7% interest rates. And so, yes, inventory is low, but demand has been squashed, at least for the time being, even lower. So that's where you start to achieve some of that market equilibrium, right? It was on fire earlier this year, and as we talked about on Friday, there was a lot more houses. There was a lot more buyers in market than there was sellers, and now it's like, yeah, the inventory is increasing. We took a look at that on Friday, and maybe that's doubled, from earlier in this year. But the amount of buyers in market's also substantially going down. So we're really reaching sort of parity in the supply and demand equation, or even an imbalance in the other direction where there's more supply than demand. That's why we'll keep a look at a close watch on some of these things like household debt, housing starts, building permits, those sort of existing home sales on Friday. We'll keep a look at those things this week. We'll pay attention to those, see what those are coming in at, and then also correspondingly, what's the market doing as a result of those things being published and kind of how they're coming out as opposed to where they're expected. So again, I didn't want to do like a super long update today because, we're already going on 10 minutes or so. Time really flies when we start to dig into some of this stuff. So I just wanted to pop on, give you guys a quick update, let you know what we're looking at for this week and some of the things that might be coming up. So if you are a buyer in market, we'll see what rates are going to do. If you are a seller in market, we'll see how the supply-demand equation continues to shape up. And sort of as we come into the winter market and getting snow earlier than I would like to get snow, it is what it is. But we'll keep an eye on how the market continues to shape up. Again, thank you guys for watching. Appreciate your guys' continued support. Please drop a like, drop a comment. Let us know what content you guys want to see. And I hope everybody has a good week, and we'll probably see you guys tomorrow or Wednesday as things shake out. So until next time, thank you very much. Thanks for watching.